All right. Great. Awesome. We have several people that are continuing to funnel in. And so I know that you guys your time is valuable. And so like I said, it's going to take about 15, 20 minutes going through the material, and there'll be some time for questions and answers at the end. We will try to wrap it up by about 1:30 so that I can make sure I don't, take too much of your time. And then for those of you who are joining us and have questions, please go ahead and type those questions into the comments box as we go forward. So let me go ahead and get started while a few more people are coming in and talk to you about how you can figure out who I am, about my background. So again, my name is Dan Handford. I am the founder of the Multifamily Investor Nation group, and glad you are here on the webinar. I'm sure most of you found me either on Facebook or through the meetup groups, or some sort of a friend maybe tagged you and told you to come join. But we're all about trying to help the multifamily investor and being part of a high quality group that can get together and dialogue about various topics around multifamily. We have a lot of good speakers coming up over the webinars over the next several weeks. Right now, my goal is to do a weekly webinar. And so next week we have Jonathan Twombly going to be joining us. And so I'll be sending out a message about that. So make sure if you're not on our Facebook group that you go to Facebook and type in Multifamily Investor Nation. And that way you can be notified when the next webinar comes in. You can also go to our YouTube channel. Go to youtube.com. I don't know what the actual URL is, but if you just type in Multifamily Investor Nation. We had a goal of getting 100 subscribers this week, and thankfully we have done that. I think the last time I checked, we were at 101. And so on our YouTube channel, we'll be posting stories from our members of the Multifamily Investor Nation to talk about some properties that they have closed on recently, and just talking about their process through that. And so if you are listening and you have closed a property recently, send me a message, send me an email, and let me know, either whether it's through Facebook or whatever. Send me a message and let me know so that we can maybe schedule a time to do a webinar with you to discuss some of the things that you learned through that process. It's always good to share that with others, to allow them to be able to learn, kind of what were some of the things that you might have done to make sure that your property closed. But so my background and my story, you can go to Tough Decisions for Entrepreneurs podcast, which can be found on iTunes as well as Google Play and all the different platforms, Spotify, to be able to find out a little bit more about myself and my wife. So you can go to toughdecisions.net, and at toughdecisions.net on the top of the page, there's a little button or a little link that says Our Story. And it's our first episode we ever did together. It's called Episode 0, talking a little bit about me and my background and my wife and how we interact together with our various businesses. So I don't want to take that time right now to do that. So thank you for those of you who have joined us. And again, as you're joining us, go ahead and, if you're on Facebook, go ahead and press like, and also comment to let us know exactly where you are, where you're from. And then on Zoom, do the same thing. On the comments box, just type in where you're from. And we're gonna go ahead and dive into the material now, because I know your time is valuable. So the topic today is going to be about syndication, about how does an apartment syndicator make money. Obviously, we know some of the standard things, which, the first thing I wanted to cover with you is obviously about the acquisition fee. So most of you, if you have done any research at all in the multifamily syndication space, you realize that one way that you can make money as a syndicator is via an acquisition fee. Most of the time, it's going to be anywhere between 0.5 to about 5%. And the way that it's usually set is based on the size of the property. So if you're doing a smaller kind of mom and pop style, 30, 50 units, somewhere around in there, then your fee might be a little bit higher. It might be more closer to that 4 or 5% mark. If you're doing more of your larger apartments, then that fee usually goes down. So typically in our cases, because we're focusing primarily on 150 units or more, our fee is usually around about 2 to 3%, depending on the complexity of the property and various things like that. So that is definitely one area where you can make money as a syndicator and putting some of these deals together, is with that acquisition fee. Now, one thing I'll tell you about the acquisition fee that a lot of people miss is that a lot of times you'll set that acquisition fee based on the purchase price, and that's actually not what you should be doing. You should be setting that acquisition fee based on the purchase price plus any type of CapEx that goes on top of that. So let's just say you're going to buy a property for $10 million and you're going to add $2 million on top of that for CapEx that you're going to have to raise or finance, or somehow the total project costs is going to be closer to, it's going to be right around that $12 million mark. And so you want that acquisition fee, whether it be 2 or 3 or 5%, to be based on the overall project cost and not just on the purchase price. So hopefully that was very helpful for you there, because I know a lot of people I've talked to, they only based off the purchase price, but as a syndicator, you should be paid for the overall project cost, not just the purchase price. Now, if you're a realtor, real estate agent, real estate broker, you do have opportunities to be able to share in some of the commissions on some of these properties. Now, I kind of have a different slant to this, and that I wouldn't always necessarily recommend this, because especially when you get into the larger properties, obviously when you get into the larger properties, the commission amounts are lower because of the size of the property. But when you're starting to talk about the smaller, 10, 15, 20, 30, 40 unit properties, usually there's a real estate commission that can be split with the broker. And if it's a broker that doesn't normally have these types of properties, then I don't really necessarily have a problem with it. But if you're trying to build a relationship with a broker to go in there and split their fee, it doesn't really motivate them to want to send you any type of off-market or pocket listings. Those listings that they don't send out in the full market and blast it out. They're cherry picking certain people that they know can close on the deal. So keep that in mind. I know most of you on here are probably not real estate agents or brokers, and so you do have to be licensed in order to be able to get that type of a commission. But keep that in mind, that you don't want to upset the broker by always splitting the deal with them if you don't really necessarily have to do that. Now, the next piece here is going to be about your asset management fees. The asset management fees are typically between about 0.25% and upwards to 5%. Now, this is a pretty large range when it comes to asset management, and there's several different factors that come into play with the asset management fees. Number one, you have to figure out how hard is it going to be for you to manage that particular asset. So if it's going to be a little bit larger property, a little bit less intensive, then you might have a lower fee. Like typically ours are in the 150 unit or more space is going to be around that 2 to 3% range. Now, if you have a property that has a lot more heavy lifting, a lot more hand holding, a lot more work to do on it, meaning that it's maybe like a C minus property, like almost a D, and you're having to try to bring it up to a C plus or a B minus, somewhere around in there, then you might want to add in a few extra percentage points there for that extra work that you're going to have to do along the way. So those are the asset management fees, and those fees are based off of the collection, the income off the property. So, and those are typically paid out monthly based on the monthly income off the property. And so as that money comes in, you're going to be able to be paid that along the way to continue to manage that asset. The next type of fee that I wanted to talk to you about is what's called a construction management fee. And this is a management fee that not a lot of syndicators use because I think they're just not aware of it as much. And the construction management fee is usually between about 5 to 10%. I've seen it sometimes upwards to 20%, depending on how complex the actual project is. But this is something where, if you have a property, again, let's go back to our example where you have a $10 million property, you're going to put $2 million into it for a CapEx, those capital expenditures, and that construction to try to, maybe bring it from a C class to a B class property, then the partnership should be paid an additional fee, which is that construction management fee and that's based off of the overall amount of the actual construction. So if you're adding $2 million to that for construction or that CapEx expenditure, then that would be 5 to 10% of that overall amount. And so keep that in mind as well, that as you're creating these CapEx budgets, there are some construction management fees like that you can add into it that can help pay for some of your expenses while you're going to travel to a property, or for those of you who are out of state investors, if you have to go and fly to a property, various things like that. those construction management fees can help you for sure offset those costs, but also help pay you for some of your time. So I know a lot of you already are still working a W-2 job, so you might have to take off a day or two of work, and that construction management fee can help kind of seal the gap there. The next is if you're doing vertical integration. Vertical integration is trying to create your own property management company. And so when you create your own property management company, you can now collect that 3 to 10% property management fee to be managing that asset. Now, a lot of people that are in that smaller mom and pop space where they're getting started, have 30, 40, 50 units, it's going to be closer to 7, 8, 9, upwards to 10% for a property management fee. And so you want to keep that in mind, that that's something that you can collect yourself if you have your own property management company that's doing that, or if you're doing your own doing self property management. Now, as you get into the larger spaces, 75, 100 plus units or more, you're going to have a lower fee because you're going to be managing the manager, because you're going to have on-site property management. Now, one of the other things to keep in mind with this as you start to consider vertical integration is that if you don't have a track record or experience in managing these larger assets, even 30, 40, 50 units, you might have a hard time with the lender agreeing to that. So you might, as you're getting started, have to start off by having third-party property management company manage your asset, manage your property for you until you have a few properties under your belt, until you have some experience doing that. And so keep that in mind, that there is the opportunity to have that, to become that property management arm for your particular investor division there. Now, as I'm going through these various fees and topics, if you have questions about anything, if you're on Facebook, please just write those down and hold it to the very end. If you're on our Zoom platform, go ahead right now and find the Q&A box and type in those questions. So I do see that there's somebody that's already put a question on there. Thank you for that. I will definitely get to your question. But as you have those questions, write them down or go ahead and put them in the Q&A box on Zoom. So thank you for that. The next fee I want to talk about is what's called a refinance fee. So a lot of times when you have a large CapEx project that you're trying to do, you might have to start off with a bridge loan. So instead of going to a permanent debt where you're going into a Fannie Mae or a Freddie Mac loan, you might have to start into a bridge loan for the first 18 to 24 months until you stabilize that property after you've added a larger CapEx. And one thing you can do there is do what's called a refinance. Now, the refinance, there's definitely some extra work involved with that. There's more paperwork, there's more legwork, there's more legal work, there's a lot of different things that you have to do along the way. And so you can bake in what's called a 3 to 10% refinance fee. And that's again paid to you upon the refinance. Now, we'll also talk about some other things that you can do on a refinance in a couple of slides here that'll help you get more cash out of the deal, earlier on too. The next is what's called a disposition fee. A disposition fee is when you have a property that you are now selling, and upon the sale of that property, you can now be paid what's called a disposition fee. This disposition fee is like the acquisition fee. It's paid off of the on the acquisition fee, like we talked about, that's paid off of the purchase price plus your CapEx, so it's the total project cost. And so the refinance fees would be based on the refinanced amount, and then the disposition fees would be based on the sales price of the property. So if you bought the property, if you were say 10 million, you've added that $2 million CapEx to the project. You're now 24 months in, and you can refinance that thing for 14 million. You hold on to it for 3 more years, and you now can sell it for, let's just say, 18 million. Well, now your disposition fee, that 3 to 10%, is based on the disposition amount of the entire project. So if you're selling for 18 million, that 3 to 10% is based off of that. Most of the time, when you start to get into the larger assets, that fee is going to go down a little bit, probably maybe even dropping down to about that 2% fee. So a lot of this is all based on how well the property is going to do for the investors, which we'll talk about that here in a few minutes too. The next thing, which is this is the most profitable event or profitable thing for a syndicator is when you have some sort of capital event. So we talked a couple slides ago about refinance fees and how you can make money off of these refinances. But when you refinance, you're going to make those refinance fees, but you will also be able to do what's called a capital event split. So most of the time, these deals are separated with investors by having a 70-30 or 60-40 or even an 80-20 or 90-10 splits with your investors. And so that allows you at capital events to be able to pull off some of that equity that's being returned to the investors, and you can have some return to you and paid to you at the same time. That typically is between 10 to 40% based on where your position is on the overall deal. And so if you're splitting the deal 20% to the GP, 80% to the limited partners, the investors, then you would be able to get 20% of that cash flow as being able to take off the property during a refinance. Now, capital event is also when you sell the property. So these capital events are when you make the most money for these syndicated deals. And so at a capital event, well, as long as the project has gone really well. If the project hasn't gone so well, then you won't make too much money off of it. But I'm assuming that you guys are getting into great value add properties with lots of upside potential, and you're able to sell it for several percentage points or higher than what you actually bought it for. And so these capital events are areas where you can split those profits, if you will, on the project with your investors. So those are the things those are the various fees and different ways that a syndicator can make money. I know some of these things are probably new. I mean, are probably not new to most of you, but for those of you who are new in the apartment syndication space, I hope I was able to give you some additional insights on some fees that you might be able to add into your projects as you are doing underwriting on your projects. I think one of the things that is probably the most beneficial is being able to think about the acquisition fee as not being based on just the purchase price, but on the overall project cost. So keep that in mind when you're underwriting. And then a couple other things I wanted to mention to you to consider when adding fees to your project is that you want to make sure that you can add all of these fees if you want to, but the problem is if you add too many fees, then your returns for your investors goes way down, and you'll have a hard time finding investors to be able to come into your deal. So a lot of times as syndicators, we have to kind of slash some of these fees or remove some of the fees that aren't typical fees on every project to allow the deal to work properly and allow the investors, because at the end of the day, our customer as a syndicator is not the tenants on a property. It's not the property manager. It's not the property management company. Our customer in a syndicated deal as a syndicator is our investors. We have to make sure our investors are taken good care of. We have to make sure our investors are getting the returns that they're looking for as well. So keep all that in mind when you're doing your underwriting. You can try to bake some of these fees in to kind of see how it affects the returns, but make sure that you're always keeping your investors in mind, because I myself am an investor first. So I always think about the deals that I put together and that I underwrite and that I am a KP or loan guarantor for, and make sure that if I, as an investor, it would be a good deal for me as well. So that's all I have for today. Those are the various fees, different things about how does an apartment syndicator make money. So any questions you guys have, go ahead and right now on Facebook, you can type those questions in and type them in as soon as you can. I do have one question that I see come through on the Zoom platform, and let me pull this up real quick here. Let's see. All right, so the difference, one of the questions that I have here is what's the difference between an asset management fee and a property management fee? So an asset management fee is a fee that is paid to the partnership that has put the deal together to manage the asset, meaning they're managing the investors, they're managing the bookkeeping, they're managing, making sure that the taxes are being done at the end of the year, and they're making sure that the investors are getting paid when they're supposed to be getting paid, and making sure that the business plan that was set into place in the very beginning for the project is continuing to make sure it takes place. Now, a property management fee is a fee that is paid to the property management company to make sure that if it's a large property, to staff that property, and make sure that those property managers that are on site, or the leasing agents, the maintenance techs on the larger property, are going to have a property management company that will be managing that staff so that you don't have to. The property management companies that are managing smaller assets, those 10, 20, 30, 40, 50 units where there's not on-site property management, those are going to usually command a higher fee, but they are going to be doing your leasing. They're going to be showing the units. They're going to be doing that kind of stuff that you won't have to do, and that's that property management fee. So those are the differences between an asset management fee and a property management fee. So any questions? I don't see any more coming through, so it sounds to me like it might be good. All right, so I actually do have one coming in from Franklin. It says here, Franklin Management, what's the difference between a capital event split and an equity percentage split? So those are synonymous. So when you're talking about having an equity percentage split of 80-20 from the GP versus the LP, then that's the same thing. But a capital event is when you would actually be able to do that equity percentage split. So I called it a capital event split because some people call it different things, but it is basically the same thing. So the differences are, there is no difference between a capital event split and an equity percentage split, but it's based, the capital event split is based on each person's equity position in the overall deal. All right, so those are some great questions. I don't have any more coming through. Actually, I do have, okay, there was one question here about crowdfunding sites. Do you recommend for small apartments? I don't really have an answer to that because I don't do a lot of research into the size units that different crowdfunding platforms have. So I can't really answer that question there from Franklin Management there. So I don't have any other questions coming through. We're right at about at 123, and we will, as we're going through, we're going to be having some more webinars on various topics. And thank you so much for the feedback so far. You guys have been great. I love that you guys are participating and liking things and promoting things and sharing it. My goal here is to provide as much education as I can to help you guys out. And then on YouTube, be sure to go to our YouTube channel and subscribe to that as we add more content. I'm going to be adding more things on our YouTube channel. Some of you might have seen on our Facebook group that I have a new video studio that I've just built out, and we're going to be probably going to be shooting some videos today on some various terminology. We're going to be launching that terminology on the YouTube platform over the next couple of days and weeks. So keep that all in mind. Thank you guys so much for joining us, and we'll see you next week on Tuesday for the next webinar, and I will make sure I send that out to everybody so you know when it is, so you can register for it. And I hope you guys have a great rest of your day.